You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. This is your host, Jennings Smith. About 2 years ago, I purchased a house in Puerto Rico and I paid $28,000. There was some closing fees, etc. So we were all in for about $30,000. And we ended up holding this house for about a year and a half. I had borrowed money from a private money lender to buy it, and I wasn't worried about the house. Even though it didn't sell, we put it up on the market. It took a while. It went under contract. It fell out of contract, and we held it a little bit longer than I had hoped. I was never worried about that deal, and I never lost sleep. And you know why? Is because I paid $30,000 for this house. I knew that the retail market of this house was much higher. So I knew I had already made my money. You've heard that saying, you make money when you buy, not when you sell. We're going to break that down. It's a trite saying. What does it really mean? What does it mean to me? And how does it influence my decisions in making my next purchase? So we did end up closing on that deal. I think it closed maybe 3 months ago. We sold it for $125,000 plus a $15,000 seller's second prom note. So $140,000, massive profit on the house. Had to take our time. It took about 18 months to get it done, but obviously pretty good deal. We made a $100,000 profit on that deal. The reason that we paid that price for that house is because you can know the price of the market today. With a little bit of research, Zillow, online tools, sold comps, tax records, etc., you can see what other people have paid for houses or apartment complexes or per unit or for commercial per square foot, whatever it is. You can see fairly accurately what the price is in today's dollars. You can't know the price of the future. You don't know what it's going to be. Is it going to stay the same? Is it going to go down? We've seen that happen in recessions. We've seen that happen in economic times of upheaval, the Fed's raising rates, et cetera, et cetera. It's not that values always will go up. Sometimes they stay the same. Sometimes they even go down in real estate, in business, in any asset. And so you can't know the price in the future. You hope that the price will go up. You hope that it will appreciate. But the way that I model my deals, if that happens, that's gravy on top. That's just extra money. That's just extra good news. I need to be in something where even if the price doesn't go up, or even if the price comes down a little bit, I'm still going to be insulated, right? So I have to find deals that are going to make sense at today's prices without factoring in massive appreciation, massive escalation, because that's where I'm going to lose money. And if I want to make money when I buy, I've got to buy at the right time, because you can't control what you're going to be able to sell that asset for in the future. So we've got a deal under contract. It's closing next week in Louisiana. It's outside of New Orleans, and we're under contract for $34,000 a unit. Now, we've done our market research. We know that stuff is selling in that area for $60,000 to $75,000 per unit. So we know we're significantly under the market rate per door. It's 108 units. So if you think about that, we're getting it for $25,000 under market rate per unit times 108 units. I mean, that's $2.5 to $3 million right out of the gate. Okay, so you may say, well, Jennings, I mean, awesome. I would love to buy something that's worth $100,000 and buy it for $50,000, but people won't sell it for that. And typically they won't, but some people will. And we're going to get into that as we get into the episode, talking about strategies and how to do this kind of thing. But going back to the deal, there was a problem with the deal. The deal is in, coastal Louisiana, very high insurance. The insurance was $389,000 per year in premium. So if you break that down on a per unit basis, that's $3,500 a door per year, which is crazy expensive. I mean, I have properties that I'm paying as little as, $300 to $500 a unit. A lot of them are around $1,200 to $1,500 a unit. in more expensive areas or more hurricane prone areas. So $3,500 a unit is insanely expensive. So we dug into why is the insurance so much? Well, there were two factors that were driving this. Number one, they had Federal Pacific breaker panels and they had stab lock breakers. So Federal Pacific panels coupled with stab lock breakers, these have been discontinued. They don't use them anymore. They don't make them anymore. And they're a fire hazard. And so the insurance company knows, hey, this facility has a fire hazard that they have not mitigated. They haven't replaced these breakers. They haven't replaced all these panels. And so we're going to charge them for the additional risk. Second thing was they had a non-recourse loan on it. So agency debt is a type of loan product you can get where the only recourse the lender has is to take the property back. They can't come after you personally. They can't come after your other assets. So it's a very good tool to protect yourself as you grow your portfolio, especially with bigger deals. But when you take those kind of loans, there's more restrictions on them because the bank knows, man, the only thing we have to protect our money is this asset. There's nothing to go after with these other investors personally. And so we want to make sure this thing is insured to the hilt, insured to the nines. And we're going to give you all these insurance requirements. The insurance company is going to have to underwrite to our standards, and that's going to drive the premium as well. So those two things were driving that. Also, they were about $100 under market rent, plus they weren't charging for utilities and water, so all that money was going right out the door. So looking at this, their NOI, their net operating income on the property was low. It was like $90,000 a year, which is pretty bad on a property of that size. And so we looked at this and did our market research. We knew what we could get for rents. We knew what the other units in the area were worth. We talked to an insurance company, and we talked to a banking company or a banker, and we said, hey, will you get us a new loan? Like if we buy this, we're not going to assume their loan. We're going to get a new loan. What are your insurance requirements? Took those insurance requirements to the insurance company. They underwrote it. We said, hey, well, we're going to replace these Federal Pacific panels. We're going to replace these stab lock breakers. Yes, it's going to cost us a couple $100,000 to do this, but what is that going to do to our premium if you don't have to insure that risk? On top of that, there was a little corner of two buildings, like I'm talking about soffit overhang, that were in a flood zone. So we went through the process with the flood maps and FEMA, and we got those buildings out of the flood zone. So between all of that, right, those three items, the bank, the electrical issue, and the flood zone issue, we were able to get the premium down from $388,000 to $128,000 a year. So massive delta. That's $250,000. That's not going out the door straight to the insurance company, but rather being retained in the property for cash flow, for property improvements, for distribution to investors. And that's going to tell a story to the next bank that refinances it or the next person that buys it from us if we go to sell it in a couple of years, that look how profitable this apartment complex is. And so they may be willing to pay market rate $60,000 to $70,000 a unit for this property when we sell it. And so we can solve that problem. Well, why? Why would the guy sell it this cheap? Why would he not do this himself? And we like to ask these questions, and I think they're important questions to ask so that you don't get stuck with a problem that you don't understand, or maybe there's a hidden black swan that you don't realize is there until you buy it, and then you've uncovered a lot of risks that you can't mitigate. But sometimes people just want to get stuff gone. They want to stop losing money. They want to stop paying the insurance companies. They want to stop paying taxes. They want to stop managing it. They don't want to deal with it anymore. They just want it gone. Banks are notorious for this. How did I buy that house in Puerto Rico for $30,000? Well, because it was foreclosed on. It was foreclosed on, then it was put into a servicing company who tried to sell it. They tried to sell it for a year or so. They couldn't sell it. The bank finally said, we just want it off our books. What will you give us for this property? We bid on it and we won. Right? So a house that is worth $140,000, I mean, that's what we sold it for, was bought because we could give certainty of close. We could close in 4 days. We could wire them the cash. They could sign the title over to us and it could be off of their books. And now they don't have to deal with that anymore. The same thing with the seller in Louisiana. The father owned it. He passed away. He gave it to his son. His son lives out of state, like halfway across the country. is not involved in multifamily real estate at all, doesn't have any idea on how to operate these things, maybe didn't even know that he had an electrical problem. Maybe he didn't even know what was driving his insurance costs. All he knew that he was losing money every month and he was having to prop up this. He was having to pay his loan. He had a massive liability on his balance sheet and he wanted to focus on his business here in the East Coast that was making money and profitable. And he did not want this liability on his books. So he was willing to sell it for essentially his loan balance, a few $100,000 more, but basically just to wipe the debt away, get rid of it, and be done with it. And so these kind of deals can and do happen. And those are the kind of deals that I like. These are the kind of deals where I can see what is the market rate for the unit today. Can I get in at a lower price? Because the one thing that you can control, we talked about that, you can know the price of the market today, but you can't know the price of the market in the future. And you can't control what people are going to pay for that. Because in the future, sellers will pay what they're going to pay. You can't control that. You can't control what banks are going to lend them or how they're going to raise their capital or how they're going to perform and close the deal. But you can control how much am I willing to pay today? How much am I willing to pay for this asset knowing what it's worth in today's dollars? And if it's less than what it's worth in today's dollars, I probably can make a deal. And I might even get lucky. If the market improves, I'm going to get lucky. If I solve these problems, I'm going to get lucky. I'm going to make a profit. Maybe I'll make a lot of money. Maybe I'll make an average amount of money. Maybe I'll make a ton of money and it'll go really, really well. But any way I cut it, I'm not overpaying so that if one little thing goes wrong or the economy turns or whatever, now I'm upside down. Now I see deals coming across my plate regularly now where loan balances and renovation dollars and investor money put into the deal is way more than it's worth. In some cases, the property's not even worth what the loan balance is. Forget the down payment, forget the renovation dollars. That's a lost cause. It's not even worth what the balance of the loan is. Banks have them back and they're willing to cut a deal. They want to get rid of this property. They want it off their books. I'm going to talk about a deal that I didn't do so well on. I bought a property in Clemson. If you want to hear the whole podcast on it, it's $6.1 million deal gone wrong. That's the title of the podcast episode. This was a deal that was in my alma mater. I went to Clemson University and I kind of fell in love with this deal. And I think we paid $75,000, maybe $80,000 a unit. And it was worth about $80,000 a unit. Now, there was an improvement. We could raise rents. We could make it happen. We could maybe get some students in there and get more revenue on it. I'm thinking Clemson's a good market. It's going to appreciate. And I started to kind of play that appreciation game on that Clemson deal just because I was so in love with that market. Really, really liked it. And times were okay. Times were good. Debt was cheap, et cetera, et cetera. I had a floating rate bridge debt on it, and it started to freak me out where I've got to get rid of this debt. So as the Fed started to raise the rates and as my payments started to go up, it started to erase the value. Multifamily commercial real estate is very, very tied to the federal funds rate. And as the federal fund rate goes up, it decompresses the cap rate of an area, decompresses the cap rate of a market. And so when that happens to you, it starts to erase value. And if you don't have a large buffer, let's say I had bought that property for $35,000, $40,000 a unit, well, it's going to start eating into your break even. And long story short, we ended up selling that at a break even. We got the loan paid off. We got the investors all their money back. I think they made maybe 3 or 4% on the deal. I made nothing and we walked away. But that's what happens when you get into a deal and you're paying market rate. You're paying retail pricing. Okay. And it could have gone a lot worse, right? Because that's a decent scenario to at least walk away break even, because I know a lot of my colleagues that are not walking away from deals at break even. They're losing 50 to 100% of their investor capital. And in some cases, they're getting foreclosed on top of that. So how do you control what you are willing to pay? I'm looking at a deal right now. It's a series of seller finance notes, right? So this guy has bought, well, let's just say, for example, 50 houses. He's bought 50 houses, and instead of turning them into rentals, he has turned them into mortgages. So he sold the homes owner financed. He's collected a down payment, a couple $1,000s. And these people are paying $600,000, $700,000, $800,000 a month, depending on how nice the house is. And they're paying this owner financed mortgage down. Most of these are sold at an 8% rate. That's the average of all the notes together is about 8%. And so he wants to get rid of it. He wants to be done. He wants to stop dealing with managing these notes, even though it's not a huge headache. He just doesn't want to do it. Because the nice thing about notes and mortgages is you're not responsible for the taxes. You're not responsible for the insurance. If those things go up, well, the homeowner has to pay for that. You're not responsible for the roof, the air conditioning. You're not responsible for the toilets leaking. You're not the maintenance guy. You are the lender. And if you have a mortgage, you know that if your toilet leaks or your dishwasher stops working, you're not calling your bank. You're not calling Wells Fargo telling them to come fix your dishwasher. You're paying your mortgage and you're calling the guy and getting it fixed, or you're fixing it yourself. It's not the bank's problem to maintain your home for you. All they are is the lender. So this is how he's structured all of these notes. And so I'm looking at this thinking, okay, so if I paid retail price for these, what is the note balance? And the note balance is about $3 million. So if I pay retail for this, I'm going to pay him $3 million. What am I going to make? Well, I'm going to make 9% on my money because the loans were sold at 9%. And what is the value of the homes? Well, the value of the homes is about $6 million. So my LTV is only 50%. That's a pretty safe LTV. And if I have to foreclose or repossess a house, I'm going to be able to resell it maybe for more. And so I'm fairly insulated in the case of a default. But I don't like to pay retail pricing, right? 100% of the face value of the note is even above retail. Because if you go onto the open markets, these things trade for 90% if they're a really nice performing note or less. And so my thought is, okay, what kind of discount does this make sense to me? Because 9% on my money, even though it's decent, like I can get better than that investing in my own deals. I can get better than that doing private money lending. I have more opportunity to make better than 9%. And so I'm looking at this, what discount rate do I need to buy this at? And so another piece of the pie is he's willing to owner finance the deal. So I don't have to come up with $3 million in cash. I got to come up with part of that as a down payment, but he'll owner finance the balance to me at 5% interest. And so now I'm kind of looking at, there's an arbitrage there of 4% on the interest or 3% on the interest, 8% to 5%. And so now I still want a discount. And so what I've kind of hammered out is if my down payment is lower, I'm willing to pay up to 75% of the face value. If he wants me to put a little bit more down, I'm willing to pay up to 68% of the face value. So that way I'm getting the notes at a 25 to 30% discount. Plus I'm getting the interest. Plus if somebody defaults, I can take the house back and I can resell it. This is looking like a solid deal. And on top of that, I have good leverage. I have leverage with the seller of 70 to 80% at an attractive rate at a 7-year term. So I can make the arbitrage on that, and I'm not tying up $3 million worth of cash to make this return. Because if I had to do that, I probably have to get it at even a more significant discount. But he's willing to owner finance the deal, which makes it more attractive. And so this is how you control what you're willing to pay, is running the numbers. Being like, what is this worth to me? What kind of discount where this is a no-brainer deal? This makes a whole lot of sense. I can do the math on the back of a napkin and it's going to be a good deal. I don't have to go through a 10-page underwriting spreadsheet to figure out that this is a great deal. I mean, we have another deal that's come across our plate. It's 400 plus units, and somehow these guys have negotiated a price for like less than $6,000 a unit, and it's mid 2000s build. So that deal, that's all the underwriting really I need to do. I know, holy cow, the land alone is worth $6,000 a lot. Not to mention these townhomes and apartments built on top of it. This is a deal that could make sense. There's money to be made here. I'm going to dig into this deal further. But my first reaction in looking at the deal is how? How is this guy selling it for this cheap? And I'm not going to get into the details of how that deal is evolving, but it is possible. And a deal like that can change your life. You're talking 400 plus units. I mean, even at $40,000, $50,000 a door is worth $20 million plus. So it's big arbitrage, $35,000 to $40,000 per unit arbitrage on a deal like that. So number one, how do you find and how do you control what you're willing to pay? I mean, one is being disciplined, making a lot of offers and having a lot of options. If you're only making one offer a month or one offer every couple weeks, your chances aren't good because these are needles in haystacks. These deals don't come along every day, although they are there. Second thing is, do you believe that people will sell it cheap? Some people refuse to believe that these deals are even out there, that they're even possible, that this is just, for show, guru speak, et cetera, but you don't know the situation. We talked about in the beginning of the episode, there's sometimes people just want a problem solved. They want it gone. They want it over. They want it done with. They don't care if they're losing money. They don't care if they're breaking even. They don't care if they could list it with a broker and wait 6 or 9 months and maybe get a better price. They just want it gone. But in doing these kind of deals, you have to put yourself in a position to act. Talking about the Puerto Rico deal, I literally had less than 2 or 3 hours to make a decision on that deal. It was sent to me. Hey, do you want it? I'm sending it out to 4 other people. Do you want it? I looked at it for literally 10, 15 minutes and was able to make a decision that, hey, this is going to work out. Replied, yes, I do. Then we had 3 or 4 days before we had to wire in the money. In that point, we did a little bit more digging. We made sure that the house was there, that it wasn't burned down, that it didn't have, excessive tax liens on it or anything that was going to bite us in the butt later. We did all that. But within knowing about the deal, within 15 minutes, I had to make a commitment that, yes, I wanted it. And within 4 days, I had to wire in the cash. So I had to have the cash or have access to the cash. In that example, I had access to the cash. I went to my investors, said, hey, do you want to do this deal with me? Somebody said, yep, absolutely. Wired over the money. I wired it into them. Boom, done deal. 18 months later, we turned a pretty significant profit on it. So you have to be in the position to act. The deal in Louisiana that we're working on, right? We were fighting with somebody else. They put it under contract, all cash for less than we did, but they flaked out. They didn't have the ability to act. And so we were able to come behind them, put it under contract after they failed. And we had to have the ability to act. We had to have the ability to get the loan. We had the teammates to get the loan. We had to have the ability to have the down payment, $1.2 million. We got the down payment. And so now we're closing next week. We got the commitment letter from the bank. We're oversubscribed on the raise, and we can act on that. The reason we can act on that is because of our relationships and our network. So the business that I'm in is I'm a relationship builder. I'm a relationship broker. Each person I meet, I'm looking and seeing what kind of skills do they have? What kind of resources do they have? Could they be somebody that I could help? Could they be somebody that could help me? All right, how can I connect them? And every time I see a deal, I'm not thinking, well, I don't have X millions of dollars to buy this deal myself, or I don't have the ability to get that loan, or I don't want to manage that property, or whatever the things that I don't want to do are. I think about, is there someone in my network that could do that or would want to do that or would be a blessing for? I was speaking to a lender literally yesterday. He's just foreclosed on 2 properties, one in Texas, one in Georgia, 409 units and 330 units. He said, Jennings, we're trying to operate these, but I'm a lender. I'm not an operator. I need an operator to partner with me, and I will give him equity in the deal. If he'll run these properties for me, we got the money. We're in primary loan. We're the lender. So we don't have any risk of foreclosure. I just need somebody to operate these properties for me. Now, do I want to take on a 400 plus property in Texas and a 300 plus property in Georgia? No, I don't. But I have partners. I have relationships. I know how I can connect somebody, and maybe I can get compensated. Maybe I can carve off a couple percent point of equity in those deals just by being that relationship broker who's connecting the people together to make everybody successful. So getting yourself in the position to act leads into the next and last point, putting yourself in the flow of opportunity. Where are these people? Where are they hanging out? What are they doing? How can I connect with them? How can I build relationships with them? We built an education company, and that's not even the right term for it. It's called the Deal Room. But what it is it's just a tribe. It's a community of network and relationships of people that are doing what we're doing. That's where the Louisiana deal came from. That's where the 400 plus unit deal came from. That's where the deal in Puerto Rico came from. Like, these are people that I've connected with and made relationships with. I'm helping them make money. They're helping me make money and getting in the position. The lender came from a relationship from Yaden. As a teenager, he was friends with this guy who did a couple loans for us. And now I'm reaching back out to him to see if we can help him with this. And putting yourself in the flow of opportunity, because I don't see myself as, I'm going to become this off-market guru. I'm going to start sending out 10,000 letters a day to these people and fielding all these calls and whittling down the needle in a haystack. Now, that may be a skill that you have. That may be something that you're interested in. But where I'm at right now in my career is I'm connected to money. I'm connected to capital. I'm connected to lenders. I'm connected to loan sponsors. I'm connected to deal flow. And so how can I put all those pieces together, structure a deal where everybody wins? That's kind of my zone of genius in putting myself in the flow of opportunity. That's why we built the Facebook group with 25,000 people. That's why we're doing the podcast. That's why we're doing the social media reels. That's why we're doing the Deal Room, is to build further relationships, to know more people, to help more people, to connect more people. So if this is you, you've got to start plugging into relationships with people that you want to be like, people that you want to be around, people that are doing bigger things than you are, bigger deals than you are, so that you can get access to this flow of opportunity. These guys that found this 400 plus unit, they don't have the money. They don't have the down payment. They don't have their lending relationships, but they're still going to get compensated, and compensated very, very well, because they do have a piece of the equation that is needed, which is the deal. But they're going to have to share some of that because they don't have all the parts and pieces themselves, and that's okay. Everybody has to start somewhere, and that's where they are right now. So if you're looking to plug into a community where you are in the flow of opportunity, the flow of deals, the flow of money, the flow of other deal makers who are putting things together and making themselves more valuable, making it so that people want them in their deal so they can get a piece of equity, hit me up. Let's talk about the Deal Room. You know, there is a cost to it. It's not much. It's $400 a month, so it's fairly reasonable to be a part of the community. You'll have to have real estate experience already. We've got a hard line on that. If you're an entrepreneur or a business owner, we make exception for that because we know you've got the grit and what it takes. But this is an easy plug and play way to get started in building those relationships and those networks that are going to change and unlock your life. Have a great week. Peace.
This is thepodcastfactory.com.